what is the trajectory of our business? So the question here is our revenue increasing? Are the profit margins predictable? And are we becoming more efficient over time? That would be ideal. So, and one thing I quickly want to mention is it's really important for e-commerce businesses to be profitable on every single order if possible, because they generally don't have a lot of repeat customer behavior. So they want to either be break even on the first order or better. And sort of the very exceptional e-commerce businesses are very profitable even on the first order after marketing. So let's jump into this. So here you can see summary financials for a 3-month period, June, July, August. And on the right, we have as a percent of revenue breakdown. So we're going to walk through to understand, is a business growing? What is happening with our margins? And sort of, is the business overall profitable? So let's dive in to try to address these questions. So in any business, you'll have customers. And so we have new customers and returning customers. And you can see that all of these numbers are increasing, although the new customers are tapering off a little bit in August. And those customers place orders. So the orders will be higher than the total number of human customers. So the orders are going up as well, and that's a higher number than the customers. But then each order on average will usually have more than one unit. It'll sometimes have 1.2 units, 1.3 units, 1.1 units. So units will be the highest number, then you have orders, then you have customers. So you want to make sure that when you're thinking about unit economics, you have to know, are you thinking about orders, are you thinking about customers? What are you actually analyzing? Next, we have our revenue. So our revenue is going up. You can see it goes up 45% in July, 15% in August. And really, what we're going to do now is dive into the product costs and the fulfillment costs. So on a normal income statement prepared by accountants, these would all be in your COGS. But for e-commerce, I like to split the sort of product COGS into one bucket. And this is what we call your gross profit, your product gross profit. And then the fulfillment into a second bucket. So we call that fulfillment. And then the revenue minus the product COGS minus the fulfillment. So the product COGS is what does it take to make the product. Fulfillment is what does it take to get it to the customer's door. Leaves you with your contribution margin. So how much is left over after you've delivered the product. And with your contribution margin, you can basically make your investments in marketing and then pay your fixed costs and your OPEX, things like payroll, enterprise software, office rent, etc. So our revenue is going up. Let's look at our margins in terms of our product costs. So are our margins predictable? So you can see here, I just took the cost and divided it by the revenue. And you can see that the product cost as a percentage of revenue is actually going down a little bit, 19%, 18%, 17.7%. And then really what we're trying to figure out is, does the overall cost of product increase or decrease over time? You can see here that this is the cost of the product, and this is our revenue minus the COGS for product. You can see that we're converting about 73% of our revenue to product gross profit. And so this number is pretty predictable over time. So I would say yes, in the sense of the production of our product, our margins are very predictable. Next, if we move to fulfillment, we want to see, okay, as a percentage of revenue, how much is our fulfillment costing us? So you can see here that it goes from 30 to about 32%. So still relatively predictable. These numbers are going up. And when you break down this percent of revenue and you take each sort of individual line item and divide it by the revenue, it's easy to pinpoint. So where are you seeing sort of shifts? So here you can see actually the pick and pack and the packaging is kind of goes down, but it's sort of stable. But everything else seems to kind of go up a little bit over time. And so if you see that we're losing, 2% of revenue to the fulfillment, you can kind of say, okay, looks like the shipping cost has gone up a little bit and some of these other charges have gone up a little bit. So at the end here, you take our revenue minus the product cost minus fulfillment, and you have your contribution margin. And so we can see that contribution margin is 43% of revenue, then 41.5% of revenue, then sort of 42%. So again, that is very stable. And so you can see that our margins are stable, our revenue is increasing. And then finally, we want to understand, as a percentage of revenue, what's happening with our marketing. And down below, we're going to break down our per unit marketing cost, which is your customer acquisition cost. But just at a very high level, you can see marketing was 29% of revenue, then it was 39% of revenue. So that's a big jump, and then 31% of revenue. And again, usually you see marketing bouncing around like this when you're trying to scale e-commerce businesses. So it's good to have, metrics to understand where you're at. And so post-marketing contribution margin, so your contribution margin minus your marketing, in this month it left you $42,000 to basically pay for your other expenses. And this month it was $14,000, which is just 3% of revenue. And finally it was 11% of revenue, which is $56,000. So with these numbers, you pay your payroll and all of your other OpEx expenses. So here you see we have $20,000 in OpEx, $24,000, $23,000. And at the end of the day, we have operating income, meaning like we made a profit overall. In the first month, in the second month, we actually lost money. And in the third month, we made money again. So 7.5%, negative 2.2%, 6.4%. So this jump in the marketing actually pushed us into losing money in the second month. So this is a good way to get a high level sense of what is a trajectory of your business.